Welcome back to Real Estate Mindset. It is not showing this video as live right now. Can you guys just make sure that I'm live right now? I'm just going to sit here and talk until you guys can confirm I'm live right now. It is not showing that I'm live, you guys. Can you guys hear me right now? I don't think I'm live right now. I think there's something wrong there. Let me just type real quick. Am I live? Heck. This is messed up, you guys. It is not showing that I'm live. I may have to... Okay, I think you guys... Can you guys see me? Can you guys... Am I good? Because this is not showing live right now. I have no idea. I don't want to start this podcast. Okay, I am live. Oh my gosh. Okay. That wasn't embarrassing. I am so sorry for that, guys. Something's up with StreamYard. It's not showing that I'm live right now. I can't see anything. This is crazy. So you can hear me good. I am live. I'm embarrassing myself. I am so sorry, you guys. Normally I don't start a live out this way, but good morning to everyone. Happy Wednesday. Welcome to the Real Estate Mindset morning real estate update. And we're going to get started really quickly here, you guys. And I think you guys are going to like it. We're going to spend a lot of time kind of listening to a video from, excuse me, Danielle DiMartino Booth. We've listened to her already. She's going to go into some pretty important things about what's happening in the background. Now, obviously, you guys, and we're going to run into this market analysis quickly here. I cannot believe I don't have my live on. This is so crazy to me. I feel like I'm flying blind right now. And this is really awkward to me because the StreamYard's glitching out. So just if anything goes wrong, you guys, let me know in the comments because I can't see anything right now. Very awkward. But anyways, what I was saying is everyone thinks that the market is doing so well, that the economy is doing well. And I would agree that the economy with, most of the data, it looks like it's running red hot. But then I look at, further into the situation. I remember the quantitative tightening. I remember the quantitative easing. I remember all of this stuff. Now, here's the reality, you guys, of what's going on in the market right now. Unemployment, even though it's still low, it is still low historically, but the unemployment rate is going up and the good jobs are going down. Okay, so the job openings for good jobs, they're going down. So the unemployment is starting to go down. That's an absolutely great thing, you guys. Also, what's going down is savings. The consumer savings is also plummeting. Another thing, consumer credit card debt is absolutely skyrocketing. Defaults are also starting to get out of control. Okay. The trajectory of those trends are ridiculous. And that's really the one. Well, there's a few things, guys, but the thing with the 1929 depression, Great Depression, defaults. So if consumers can no longer make their bill payments, we're going to go into depression. That's a fact. But the thing is are the consumers going to be okay? Defaults are going up, you guys. Another thing that's going up right now is bankruptcies, both corporate bankruptcies, Chapter 11 and Chapter 13 bankruptcies. And Chapter 13 bankruptcies is more like a homeowner bankruptcy. So that's going up. Also, what's going up? Evictions are skyrocketing. I have another video I'm going to put out today, and I'm going to show you guys like the reality of some zip codes. Like some zip codes are 700% above pre-pandemic for evictions. So I'm going to go over that, you guys. Also, another thing, the M2 money supply is shrinking at the fastest rate since the Great Depression. We've had bank runs this year, the second, third, and fourth largest bank runs this year. Now, some people did buy, okay? If you guys wanted to buy, then you probably also joined the 93% of homeowners in 2023 that have buyer's regret. So I get it. Some people, haters, I can't help myself. I just have to buy. Fine, you guys, go buy, but definitely don't overextend yourself. Okay. The one thing that I would plead with you guys is please don't overextend yourself. It's super toxic and super expensive right now. But think about that, guys. If anyone was like, should I have bought? Should I have not bought? It depends on the deal. Okay. And we go into that a lot. And I'm going to go into that tomorrow, how to find a great deal. I was going to do that today, but I ran out of time. Anyways, my point in telling you guys all this is be happy you're not part of that 93%. Now, obviously, Jeff is probably not part of that 93%. Jeff's situation was different. But again, you guys, this, that survey that I did a video on yesterday, it really showed me how everyone is failing. To me, that was like a performance report also for realtors. Okay, when 93% of buyers have regret, there's something wrong. Right? I mean, think about it. So anyways, we're going to get started, you guys. I apologize for the rambling. So we're going to do I can't do timestamps. I don't have my time up. I'm completely naked right now. I hate it so much. I can't see my time, so I cannot do timestamps. Super sorry about that. But we're going to just get started in this quote real quick. I want to start the morning off positively before any of the trolls come on and harass us. Okay, we're going to start with positivity. Here's our morning quote from Madam C.J. Walker. I love this one. Don't sit down and wait for the opportunities to come. Okay, get up and make them. So to me, it's saying basically convenience and procrastination is expensive. So in other words, don't just stay on the sideline. That's what that's telling me, okay? So I'm not just staying on the sidelines. I'm creating an opportunity as I'm sitting on the sideline. And how am I doing that, y'all? What opportunities am I creating as I'm on the sideline? Am I just sitting here rambling about the housing market being so unaffordable and all the realtors? No, I'm increasing my purchasing power. I'm working like crazy. You guys see how hard I'm working. And this is not my full-time job. I have a full-time job. So I'm working like a madman and I'm educating myself. I mean, look at all of the data that we cover. So again, I think the important thing that most people don't understand about our community and about what many of us do is a lot of people just think we're on the sidelines with our heads in the sand, crossing our fingers, hoping home prices are going to go down. The reality is I'm on the sideline right now, but I am actively looking. Every single day I'm hunting for a great deal. Every single day I'm working on my purchasing power. Every single day I'm watching the data. So I'm not blinding, I'm not blinding myself is the point I'm trying to make. And I want to give a shout out and then we're going to start on our market update. Okay. This is the shout out I want to give. Let me set up my slides real quick. So I've been seeing some comments. Some of you guys have been getting your realtor license. And I just want to say this. I am so freaking proud of you guys. Melissa did. Who else was going to do it? Don't Move to Texas. I think Johnny may have. I think Jeff was considering it. Moses got his realtor license. I just want to say you guys should be so freaking proud of yourself. I am so excited, especially Don't Move to Texas. When you get your license, sir, and you have your MLS access, hit me up because I'm going to show you how to use that beast. And if any realtors are watching this, this is what I want to say. Okay, I'm not trying to hurt people's feelings. I'm not trying to bully realtors. What I'm trying to do is kind of push realtors up against the wall a little bit into a corner and say we need to do a better job. Okay. And if you're a great realtor and you're watching this, you know very well what I'm saying is true. You know the awful amount of talent we have in our industry. Now, having said that, there are phenomenal realtors. They're just rare. Okay. They're just rare. And they make a lot of money. All right. I'm gonna move on to the next thing because I'm gonna get some hate mail. I always get hate mail when I talk about realtors commissions, but we're gonna start with our market analysis, starting with the 10-year treasury. Look at this, guys. So we've been watching the 10-year, every day for the last 2 weeks. Look at it's at 3.74% right now. This was just at 4%. Again, this is telling us like if it goes to 4%, I don't think the market can handle the 4%. But it's down right now, you guys, 5 basis points. I don't know why it's down. Maybe it's because I don't know why that's down. Maybe it's because the builders starts came out lower. I don't know though. It's really, really interesting to me. Maybe you guys know why the 10-year is down, but it's decently down. 5 basis points in one day is fairly decent. It's not closed, but we are at 3.743. Obviously, this is tracking the 30-year fixed rate mortgages, which are sitting at, as of yesterday, still high. So we're still close to 7. Most people probably getting 7, but good credit. These things average 6.88%. Okay. Again, what happened to the 7%? I mean, this is just crazy. But anyways, we're sitting at 6.88%. Now, let's look at the VIX, guys, the volatility index. I mean, this is just crazy. So, I mean, you guys see the dip this morning? And I was watching. I'm like, why is the VIX going down? And then it went back up. So the market is just all over the place. And then Carvana came out. The stock, I mean, my gosh, I'm watching some of this stuff and it's just, the market's just so emotional. Anyways, you guys, that's what the VIX is sitting at. Let's look at the CME Fed Watch tool. You see how fast I'm going through all of this? Let me move my picture for you guys. So we're in the CME Fed Watch tool, and this is basically showing us and giving us an indication as far as what the market, right, with the bulls, right, what the market is feeling like the Federal Reserve is going to do next. We're locked in. For July, obviously, they may not raise rates. They haven't met yet, but it's pretty locked in, you guys. It's going to go up the next time they meet. They're going to raise the interest rates 25 basis points. That's pretty much locked up. We're sitting at a likelihood, according to the market, 99.8% chance. That's locked in. Who doesn't take that bet? But the astonishing thing, you guys, is I see that living in Omaha always has great questions. But the astonishing thing about all this is the market has stopped pricing a second rate hike. Now there's some people, and we'll listen to Danielle here in a minute. She thinks there's going to be a second rate hike in September. Now the market is like, there's not going to be a second rate hike in September. They're giving it a 14%, essentially a 14% chance of a second rate hike in September. Now look at November. That's kind of plateaued, but it's sitting at 27.9 November. December is at 22%. So again, the market's still saying a hike, skip, maybe a hike in November, but probably not. So that's what the market is saying. I hate that I can't do timestamps. I mean, it is driving me crazy. I'm blinded, you guys. Something's wrong with StreamYard. I would have made a timestamp. So I'll have to try to figure out a way to come back. But anyways, we're going to listen to Danielle DiMartino Booth. She is an economist, a chief economist actually for Quill Economics or Quill Research, I believe. She's a lot more. What's up, Jeff? I see you, Jeff. Congratulations to this man right here, Jeff. I love you, but it's like a bittersweet thing, man. Let me tell you guys why it's bittersweet. So Jeff, waited. He found the house of his dreams. He made a crazy offer. He made this crazy letter trying to pull at the seller's heartstrings, and he successfully did. But I'm going to tell you something, Jeff, all right? This reminds me of when I go shark fishing and I go kayaking through the ocean. When I go kayaking through the ocean, when I'm shark fishing, it's freaking scary. I'm getting hit by waves. I'm almost getting thrown out of the kayak. There's sharks in the water. But when I see my friends going through the pain with me, it's just easier to get through. So, Jeff, I'm happy for you, man, but I wish you were suffering with me. Okay, maybe that's selfish of me, man, but it's just easier when your friends are going through this with you. I'm so happy for you, brother. We're going to listen to her right now. You guys are going to like it. She's going to go into some really important things that I think that if you guys really pay attention to what she's listening to and her perspective, it's really going to fill in some of the missing blanks. So it's going to be about 16 minutes. I may pause the video, you guys, halfway through so we can have a discussion. But I really, I'm pleading with you, please listen to what she's saying, because she's going to give us the opposite perspective of what CNBC has been saying this whole time. She's going to go into the job market, all kinds of stuff. Pay attention, you guys. I linked all of her stuff on the bottom. Let me go full screen here. I swear if it plays a commercial, I'm going to be so disappointed. If you guys can, let me know that the audio is good. I hope you enjoy this. I will be back to you here shortly.
Later on. But Danielle, I just want to begin. You're really sticking your neck out there, expecting that inflation will continue to fall. Many people are in the higher for longer camp. Inflation will be sticky. You, not so much. You say inflation will continue to go, and you're saying you're seeing leading indicators that inflation will continue to fall sharply as it has over the past 9 months. Tell us what led you to that view.
So inflation comes in so many forms and has so many sources that feed it. I think what's important to remember is when the Fed started tightening, what had already transpired? What caused the inflation to begin with? It started with the trade war and that first Trump tweet way back years and years ago. That's when the supply chain disruption began. And then it was amplified and completely exploded after the pandemic hit. On top of that supply chain disruption, then you had trillions and trillions and trillions of dollars of stimulus printed, directly deposited into people's checking accounts. You bypass the banking system.
That's a good point.
That's why Ben Bernanke could never hit that 2% target, because the stimulus was going through the banking system to households, to companies. What the stimulus did was bypass the banking system. No credit check. We're just giving you money. And you know what? People spent it. So the inflation that proved so elusive to Ben Bernanke exploded when the transmission mechanism was removed. And by the way, the Fed was the enabler, monetizing every last penny of those trillions of dollars. By the time the Fed stepped in and started tightening, the supply chain disruption had been mostly unwound, which is disinflationary, and the fiscal stimulus, right? That third large fiscal check was mailed out in April of 2021.
Good point.
Fed didn't start hiking until March of 2022. So they were too low for too long, But by the time they got to the party in March of 2022, most of the disinflationary pressures had already filtered through and started to bring inflation down. So what the Fed did was basically add insult to injury. In fact, I would argue that the Fed's tightening policy, Jack, has been inflationary to housing. How does that make any sense? Well, people are locked into 2.5% fixed rate mortgages. So when the Fed started tightening, you exacerbated the unaffordability aspect by making those payments even higher against the backdrop of people who will not sell their homes.
Exactly.
So now we wait.
That was good.
And this is where we get into the different components of inflation. But it's really important to understand that when the Fed started tightening, what they ended up doing was curtailing housing worse. They made housing more unaffordable than it was. And at the same time, curtailed business investment because a credit crunch followed them. So now you've cut investment off. So the Fed policy right now is actually harming the economy, but not in ways that normal tightening would. They're not taking the heat off of inflation. That was already done when the supply chain was undisrupted. That was done when the US government stopped handing people free money.
So core inflation, you know the numbers, is still running at 4 or 5% if you on an annualized basis, I think around 5%. So that's not including energy. So if you have all these disinflationary forces in the pipeline, how come core inflation is still well above 2%? And also, we should note that when people say inflation has fallen like a rock, so much of that, as you know, is base effects of you're comparing June 2023 to June 2022 when the price of oil was $120 and now it's $70. So it's really a relative game. Whereas on a month-over-month basis, it's much more accurate. And on that month-over-month basis and the 3-month annualized basis, core inflation is still sticky. So what has led to that core inflation being sticky, and why do you expect it will stop sticking very soon?
So we had this big pop in January and February in Manheim. Auto dealerships were anticipating a very robust individual income tax refund season that never manifested. But that doesn't matter. They increased their lines of credit. They went hauling into auctions, overpaying for cars, pushing that Manheim index up in January and February. That flows through to the CPI in a big way. We saw that 4.4% print on used car inflation, even though used car prices have now been falling, and they will continue to fall according to what Cox is telling us right now. I mean, if you look at what you just pulled up, total retail inventories, this is fresh data that we got out. Look at inventories without cars. That green line includes cars. That's a hockey stick. Those are dealerships having their lots refilled. And that's why we're seeing incentive spending double off of what it was last year. But non-auto retailers, retail inventories, that yellow line, they've already peaked and started to come down. We're going to see that increasingly because you heard from the CEO of General Mills, who said the catchword, the global catchword right now, destocking. Destocking. Customers are holding less inventory. We're seeing not just a reversal of going from just in time to just in case, hoarding inventory. We're seeing a correction beyond that to now where they're holding less inventory than they did prior to the pandemic. And this is something that an entire generation of operation managers have never had to deal with. They've never had to account for financing in real time. This is your shortest term financing, which by the way is your most expensive. They've never had to finance the inventory on hand. So their bosses are telling them, get rid of this stuff until final demand comes through. Craig Fuller, my good friend at FreightWaves, has been saying, it ain't happening. Inventories are not coming back. We see this through freight. And by the way, we're starting to see high-end consumption turn. He tweeted that out a few days ago. I followed up with him and he's like, it's happening, Danielle. That's a big deal. But again, what we're seeing this flow through to is destocking. When customers are holding less inventory than they had before, supply demand, you're seeing the reversal and then some of the supply shock that created inflation. Whether you're talking about small businesses the service sector or the manufacturing sector. I had like a triple chart of those three in the views of the vendors supplying all three sectors of the economy. They view their customers' inventories as being too low compared to long-term. There you go. Those red dotted lines, those are the long-term averages for these data sets. And as you can see, we have gone below those levels across the board. That's destocking.
So I just need to say, nearly none of this has to do with the monetary system, how much money there is, the cost of that money, interest rates, things that the Federal Reserve has a lot of control over. This is all in the real economy, real stuff, not ones and zeros on screens. So it's the narrative that there used to be nowhere near enough stuff to meet the demand. Cars needed these semiconductors, these advanced chips that were not coming into place. So everyone wanted a car and no one could get one. Are you saying that right now we have the exact opposite of that?
We have the exact opposite. We actually have a glut in the semiconductors that are used to make cars. Again, we've had a full reversal and then some. Now we have too much supply and too little demand chasing it. That's disinflationary by definition. And by the way, Fed policy does influence destocking to the extent, again, that you have to finance the inventory you're holding at the shortest rates. That's operating finance. That's the highest money that you can spend to carry inventory. So there's a double incentive to get rid of it because the demand's not there and it's expensive to carry it.
Danielle.
All right, guys. So we're going to go into the house. She's going to go into the house market. I just wanted to quickly, excuse me. I want to quickly pause this because I didn't want to listen to it too long. I don't want to get a copyright strike. I don't think I would, but I don't necessarily, you got to be, so here's the thing. I enjoy listening to her. When I listen to her, I know, and I saw your comments, Vital. I'm trying, Vital. You see me out here trying, brother. I think about you all the time, Vital. Dang it, you're like my little brother, Vital. You're like my little brother, and I love you. You drive me crazy, but I love you. But I'm just kidding. I like listening to her, man, because she helps me fill in the blanks. I'm not an economist. I want to buy the deal of my dreams, right? I'm not an economist. So when I listen to her, she gives me that additional perspective. She gives me a little bit more insight on what's going on in the background that I don't quite understand. So, it's kind of like I like listening to her because I believe, as of right now anyways, she's forward thinking, and I need help with understanding everything that's going on in the background. And that's really why I'm listening to her. But I felt like she brought up some pretty good points about what happened with inflation. I like how she mentioned that essentially with the quantitative easing, they bypassed the lending institutions. They basically printed stimulus straight into the consumer's bank accounts, right? And that's the first time that's happened. So obviously the inflation is sticky. She's going to go in also to, I don't think I'm going to play the entire video, you guys, but if you want to go back and listen to this video, I would suggest it. She goes in pretty heavily to stuff outside of the house market. She goes into the labor market. Again, just more perspective. Personally, again, I like listening to her, but I hope you guys are commenting, below. And I like how, she kind of put into contrast why it's so hard for especially sellers right now. As far as like the background of low interest rates for homeowners versus now that we're in the high interest rate scenario. Very good perspective. She helps me fill in the blanks. So anyways, but I'm sorry, Vital. I'm sorry, man, but we're going to listen to the rest of this right now, you guys. All right. I hope you guys enjoy it. We're going to push play, and I'm really sorry about the timestamps. I do not know what time I'm at right now.
Now let's move on to another sector, which is housing. So many people, including myself, said, mortgage rates go from 3% to 7%. That must really crush demand for housing. It kind of hasn't. And we're actually seeing, housing prices continue go up after falling down because people who are living in their houses and they have a super low mortgage rate, they don't want to move because they'll get out of that mortgage. So people who want to buy houses have to go to the new home market, the home builders. Those stocks are on a tear, by the way. And so I want to ask you about that. And that's how the bullish narrative, the optimistic, the green sort of shoots narrative. But there's also something much more dire in the multifamily world, in the single family home, as well as particularly Airbnb. So tell us, what are we looking at right now for folks who are listening to this on a podcast, as well as people who.
So real quick, guys, about the Airbnb thing, I'm not 100% sure if so there's been a little bit of discrepancy with the Airbnb information. So I'm not 100% of this right, but one of the things that she doesn't mention here as she's talking about STRs or short-term rentals, They don't go into any of the recent bans and restrictions. So all of the conclusions that she's about to give you, understand she's not even talking about the bans right now. So like I was like, man, to me, like the bans is the biggest forced selling pressure on Airbnb. I mean, it's just saying, but she doesn't cover any of that. So pay attention, guys. But she does offer some really good additional perspective.
Who are kind of having to squint and look at this table, because this really is quite alarming and interesting.
It is. It's fascinating. I mean, if you want to take a vacation in the Poconos, go for it. The price to rent an Airbnb is down by more than any county in the country, in Monroe County, where the Poconos is, in Pennsylvania, down 52% year over year. Now, the difference between the organic homeowner in the Poconos is that they've got this mortgage at 2.5%. They've got equity built up in their house. I call them the Airbnb jocks. They did not put down maybe 15% down payments, and they can get around some of that. And the mortgage that was underwritten was predicated on cash flow, and constant cash flow, by the way, in order to service the debt. So people say that this housing market is completely different than the housing market in 2006. That's correct. You don't have a bunch of subprime borrowers, but there's another chart that shows this baton handoff between organic home sellers not putting their homes on the market and the sheer number of Airbnb rentals that are out there. That's in the slide deck that accompanied that in the quill. So Airbnb,
this one?
That one. Yep. So you get 936,000 Airbnbs for rent. And that is what we call shadow inventory.
She struggles on Airbnb.
If the people, most of whom own multiple homes, right? Starwood just sold, I think, 2,000 homes to invitation homes.
Yep.
So they're getting out of the business. But you've got this massive overhang of inventory and people relying on their cash flow year over year not being down 40% or 50%. And yet that's what we have. And in fact, if you look at the largest counties across the nation, I think there are 135 of them or so, on average, Airbnb year over year rental is down 29% because the supply is just a deluge. It's the exact opposite of what we're seeing in existing home inventories. But it's sitting there, they're vacant. The owners are desperately trying to turn them from short-term rentals. You can rent this vacation home for a week to 6-month or 12-month leases, trying to lock money in, but you don't get the same cash flow generated there. It's disinflationary. And that's why the report that accompanied those two charts that came out earlier this week was so explosive, because the title said Airbnb owners are about to sell. Now, that inventory will hit alongside rising joblessness. So natural homeowners, death, divorce, taxes, property taxes are going through the roof. Floridians are choking on property insurance premiums.
True.
That have gone just skyrocketed, and trying to pay these property taxes. 65% of people who bought a home in 2022 and 2023 have reported that they cannot afford their mortgage payments. Forget carrying the cost of the house. God forbid your air conditioner, your furnace goes out. But this is just carrying the simple payment because they bought at such high price points.
Got it. So tell us about the labor market. The unemployment rate officially now stands at 3.7%. Nowhere near traditionally a recession level, although
all right, guys. So what I'm going to do is, there you are, Vital. I want you guys to do me a favor. Anytime you guys see Vital signs, I want you to encourage him. I'm worried about my brother. All right, that's all of our brother. He's part of our community. Vital Signs has been with us since the beginning. I want you guys to show love to that man. He's struggling. But Vital, I'm here to tell you, brother, if you would have bought, what list are you going to join? What bandwagon? Probably the buyer's remorse. 93. I mean, think about it, Vital, dude. 93% of the homeowners, I know it's just the survey, but 93% of people that bought in 2023 have buyer's remorse. Why is everyone so, rushing buying a house right now? 93% have regret. Why is everyone in a rush right now? But Vital, Stop it, man. I do think about you a lot, actually, because I worry about you. Because I look at Vital as like if Vital feels this way, there's a lot of people. So he's kind of like when Jeff, he keeps me grounded. Vital keeps me grounded. So I appreciate you, Vital. But you guys show some love to Vital, all right? But I want you guys to pay attention to this. We're only going to listen to about 2 more minutes. She's going to go into. Thank you, Kevin, for that live for the super chat, brother. I appreciate that. But she's going to go into the job just a little bit, about 2 minutes into the job numbers, you guys. I think it's really, really important to understand this because when we look at the overall unemployment rate, it's historically low. So what's going on behind the scenes? What's the reason for her like expectation of the housing market crash, right? I feel you, Vital. I feel you, dude. It took me a minute to change my mindset as well when I had to extend my lease. It wasn't easy. I won't lie. All right, listen to this, guys.
Actually, recessions start when unemployment is much lower than I had thought, and initial claims is at 239,000. Which is where it was in 2018, 2019. So the official data does not point to stress in the labor market, but you are tracking a lot of non-mainstream metrics that paint a very, very different story. Tell us about those.
Well, remember, initial claimants, especially in a week that contains a holiday, which Juneteenth was. So you've got your distortions there. What we track at Quill is not seasonally adjusted continuing claims. These are the number of individuals who have applied for jobless benefits. Those are your initial claimants and been approved. So they're the ones who are collecting unemployment. And right now, and in April, and in May, and in June, economists call 1 month a potential aberration. 3 months is a trend. And this is impossible to see on the screen, I understand, but that green line across the top shows you that for 3 months in a row, 90% of the US population has been living in a state with rising continuing claimants. There are only 3 states, Hawaii, Kansas, and Oklahoma, that you see on the bottom of the screen. You see those red numbers go all the way across the bottom of the screen. Red is good. Red means year over year, continuing claims are down. That's what you want to be. That's where you want to live, where the job market is the tightest. But Hawaii is about to flip. That is a huge bellwether. It's the most resistant state in the nation to joblessness because it's such a travel mecca. And it's not a travel mecca in some season. You can always go to Maui. But Hawaii is about to flip, leaving us with just Kansas and Oklahoma. I'm going to put a call in. Tom Honig, a good friend of mine, was kind enough to introduce me to Esther George. Once she's out of the Kansas City Fed, I'm going to call her up and say, what's going on? What's in the water? That those 2 particular states are so resilient, and we haven't seen continuing claims flip into the positive as we have seen for most of the rest of the nation. And that's what people need to focus on. When you've got continuing claims rising in your state, that means you know somebody, or you know somebody who knows somebody who's lost their job.
And they didn't get a new job. More importantly, that's what that shows.
That's right. That they're continuing claimants. They collect unemployment benefits week in and week out.
So what?
All right, guys. So I hope that helped a little bit. Oh, I didn't mean to put that comment. Hope that helped up a little bit. Let me move on to the next thing. I want to pull up a couple comments here, a little bit of a discussion, and then I'm going to quickly go through the rest of the video. We're going to listen to a couple of videos basically about home builder sentiment, things like that. But I like some of the things that she's talking about. I can't, I find it helpful. Again, I do my own thinking for myself, obviously, but I find it helpful, man. I mean, she's helped me kind of, again, not only fill in the blanks, but it's like it's someone else at a high level of intelligence. She used to be a Fed advisor, basically, that's seeing similar things at what I am saying. So it's just really refreshing. I hope you guys enjoyed it. I know you didn't, Vital, but you know what? At least I love you. So you got something today, at least, right? You know what? Maybe I'm patting myself on the back. I am. I'll shut up. I'm embarrassing myself. Kevin. All right, Kevin. I love your channel. Thank you, brother. You don't have to do any super chats, so I definitely appreciate it, my man. Can you get Danielle on your channel? She's one of the most knowledgeable economy experts out there. I don't know how to contact her, but I would absolutely love to have her on as a guest and for me to kind of ask him some difficult questions. So I'm going to try Kevin again, man, from the bottom of my heart. Thank you for your support. That means a lot. I really appreciate that. Couple comments from living in Omaha, man. I mean, this guy, he's got some good perspective. I really enjoy your comments. I appreciate you participating. And I know you're a realtor. You see how realtors and real estate mindset, we get along? I'm not trying to disrespect anyone. I'm just trying to point out like what's going on in the market, which is not good. Anyways, isn't the Airbnb market less than 1% of the entire market? The thing is living in Omaha, 1% of a big number is still a big number. So 1%. So here's the thing. I looked at the listings. It's hard to see how many total listings. She had on her video, they had like 980,000. I've seen reports at about 1.2 million. Now, if all of the inventory hits at once, yeah, that's going to be a big deal. But I don't, to be honest with you, brother, I think when it comes to Airbnb, I don't think that overall in the entire nation, there's going to be a giant dump of inventory, right? Which would cause additional pressure on prices to go down. But I definitely think that there's going to be an increase of inventory dump in the metro areas that are actively banning Airbnb. The two metro areas that are leading the bans right now, Dallas, okay? Dallas just crippled STRs, and that's outside of Airbnb. So it's Airbnb and all STRs. And then also Las Vegas. So Las Vegas, Dallas, I've been watching a lot of, but I think it's going to help. I think we have additional problems. My thing with Airbnb is there's two coins. There's two sides of coins on this. If you own Airbnb, you hate what the government and the cities are doing because they're infringing upon your property rights. They're infringing upon your investment. The other side of the coin, which I'm kind of on the other side of the coin, is they're taking advantage of a loophole. They're putting hotels in neighborhoods. So that's the two sides of fighting right there. But yeah, but the thing is man, like, a lot of people get stuck. Oh, it's just 1 or 2%. But brother, I mean, when we have 126 million houses, 1% of that, that's 1.2. That's a lot. And if you look at the active listings, we have less than 1%. So we have less than 1% active listings, yet we have over, you see my point? But you're not wrong, man. And that's why I wish that she would have talked about like the regulation and the bans a little bit more, because that's where I think areas will have that sudden inventory dump. I don't think it's going to happen around the nation quite like she was saying. Maybe it will. Now, here's a comment from Jeff. Okay, so no one knows what's going to happen. Just live your life. And mindset, you guys, is so important. But I also want to say that this is a great comment, but this is not a reason to justify reckless purchasing. Because if we go back to the home buyer surveys and we look at 93% of home buyers basically have resentment, they're struggling now. And actually half of them are now having financial struggles as well. So I would argue that those people can't just live their life because they recklessly purchased the biggest financial transaction of their life. But you can't let this cripple you, right? And that's why I'm pulling this comment up. This one's to you, Vital. Like, I hate to see you stressed out, Vital. I hate it. I don't want to see really anyone stress out except the haters. Let's see here. Now, here's the last one, and then I'm going to get started on the last video. Again, this is from Omaha. So, in your opinion, when will the market? Oh, I see you're not using the trigger word, Omaha. He didn't use crash, you guys. He didn't. Come on, man. I want to see you use the word crash. All right. I want you to type out crash in the comment section. Here's the thing, man. Now that I have more data, now that we've seen this current seasonality play out to the excess savings, the labor market, the lack of inventory, the lack of foreclosures, the extra strong, I think it starts. Well, and also now that I'm seeing what the quantitative easing is doing. Remember the quantitative easing back in March. That quantitative easing, we can now start seeing flow into other areas of the economy. We can see that in that M2 money supply. So we can see that happen. Now, as far as let me talk about. Here's the thing: you gotta define correction or crash. Okay, you have to define it. My definition is from peak to trough, 15% to start the bare minimum. Okay. But I think prices start going down this year again, once we're out of the spring, summer seasonality. I think prices are going to start going down from now until the end of August. So sometime between now and the end of August, we're going to start going down once again in prices. Now, here's the question living in Omaha that I have. Will all of this downward pressure and lack of fundamentals be enough to make it through next year's home buying seasonality? Okay, listen to what I'm saying. That's what we need. So I'm already looking at next year. If we make it through 2024 spring and summer home buying season without these crazy jumps like we had this year, that's when we're going to keep going into our crash. But right now, what we're seeing is we're seeing the seasonality extreme on both sides of the pendulum. So it's going to be interesting. I think that starts this year. I do believe living in Omaha, I do believe we're going to. I think we're gonna crush next year's seasonality. I thought we were gonna do it this year. It's absolutely mind blowing that it didn't happen this year to me. But I think we crushed it last year, and I think the housing market resets or corrects for several years. But what I don't know is I don't know what role the power of spring and home buying seasonality will have. When I go back to the 2009 to 2012 eras of Case-Shiller home value, I see that seasonality does play a role, even in a crashing housing market. So that's what I'm saying. Really, where I'm at now is like we got to break seasonality trends for spring, summer. So again, I think that we started this year. I think that if we can break it next year, I think we keep going down, right? But we did not break it this year. And there are several reasons that I believe why. Now, having said that, personally, I think some of the best, again, now that I understand what I know now, I'm always going to put us in the pocket. And again, unless there's a black swan, if a black swan happens, it can change everything. December to February, brother. I'm going to be trying to buy December to February in 2023. I'm going to try to buy this year. Okay. And I actually tried to buy this year already. I put in an offer, got tonight. But if I were to guess when probably like the best opportunity to buy, it's going to be 2024 or 2025 between December and February. 2024 or 2025, I think that's going to be prime. I don't know for sure. But as far as the actual trajectory of crashing or trajectory of price loss, I think that happens any week. I think it happens again between now and the end of August when kids go back to school. When is it going to happen exactly? I don't know, but that's what I'm thinking. I hope you guys can appreciate me, giving projections. Some people are like, oh, your projections weren't 100% right. You're evil. You're wrong. You crazy person. Like, be brave, man. Give some projections, Anyway, so I hope that answers your question. I'm going to move on to the next video right now. Okay, guys. Let me go into this. All right. Hope you guys enjoy. I'm going to do my other timestamp because the time just came back on. So I now have timestamps. I'm running behind. I'm really sorry, guys.
Inventories make a big difference in GDP, and we're all watching second quarter GDP very closely. Up 0.2 exactly as expected. And in the rearview mirror, last month gets downgraded by 1/10 from originally released up 0.2, now stands only up 0.1%. For the National Association of Homebuilders Market Housing Index, that's out for the month of July. And for that, we head east to Diana Olick. Diana?
Well, Rick,
By the way, I realized I should have told you what video we're watching, but this is on consumer sentiment. And real quick, I see you, Vital. And again, you guys, this market right now is nothing like 2008, except for what? Things are more unaffordable, and the equity run-up was much worse. So an affordability is way worse than 2008, and the equity run-up way worse than 2008. So I would say those things are worse, but he's not wrong. Vital, you're not wrong. This is different than 2008.
homebuilder sentiment rose 1 point in July to 56 on the NAHB index. The street was looking for a little better at 57, but this is the 7th straight month of gains and the highest level since June of last year. Anything above 50 is considered positive. Builders say low supply in the resale market is driving demand to new construction, but higher mortgage rates and higher costs for materials as well as supply side issues continue to put pressure on their market. The average rate on the 30-year fix crossed over 7% recently and has only come down slightly in the last week. Of the index's 3 components, current sales conditions in July rose 1 point to 62. Sales expectations in the next 6 months fell 2 points to 60, and that's where interest rates and affordability are having their effect. Buyer traffic increased 3 points to 40. That's the highest reading since June of last year. Now, despite higher mortgage rates, builders are using fewer incentives. Just 22% of builders report cutting prices in July. This is down from 25% in June and 27% in May. Sarah?
Oh my gosh. So they are doing incentives despite what she said. Pretty much every single builder is doing incentives. And you guys, they're doing so many incentives right now. They've literally etched out an entirely separate section of the housing market that is only for new homes. They have their own little housing market, new home builders, and the reason I'm saying that is because you cannot touch their incentives in the resale. Like example, if I want to sell my house, okay, it's a used house, right? It's a used house. So if I want to sell my house, I can't offer someone a 4.25 like Lennar is offering a 4.25 fixed rate. As a seller, I can't offer that. If I offer that, that would cost me probably $50,000 to $60,000. I can't offer it. I cannot compete with new home sales. So let's not forget that, part of the reason why we're seeing what we're seeing is because of those insane buying opportunities. And also the case in point is when we look at their books, you can see it in their net income. Their net income's down, double digits pretty much across the board. So anyways, but I wanted to show you some data. Let me put this up here. So I just wanted to point out, guys, all this optimism, people are like, Travis, they're at, 1 year highs, these stocks are doing so great. I don't care. Like, that's good. That shows me that they're selling a lot of houses right now, but the fundamentals are still not there. The bottom is falling out. You can see that in this graph right here, or this chart. This is the median sales price for new homes sold in the United States. This will update you guys in probably about a week, but you can clearly see the mountain here. Okay, you can see that the peak right here. Okay, new homes peaked. This is just median sales price. I understand that it's not value calculation, but median sales price can lead to value. I'm sorry, sales price can lead to value. But October, we peaked at 496,000. The new home median sales price has almost dropped $100,000. Okay, we're all the way down to 416,300. So I just wanted to point out that even in the face of outrageous buying incentives, even in the face of spring and summer hyper runaway inflation and buying demand, they cannot maintain that value. And again, remember, new homes lead resale. So usually this follows, right? So resale data follows this. But again, I just want to point out, in Vital, and this is true. And the reason why we see this, you guys, is because the fundamentals aren't there to sustain a $500,000 median sales price. Essentially, the locals cannot afford it. Not even close. So we see that. We see that with new homes. This is clear. So I would say, it actually rebounded a little bit, but this was down more than 15% in April. And I defined a crash as 15%. We see that in new homes. Why am I not getting more excited? Because we need to see something in resale as well. But it lags. Remember, resale lags. And the reason I'm saying that, patience. Patience. That's all. Why do we got to go rush and go chain ourselves to a house right now? You guys, I do have my timestamps working. Hope you're proud of me for that. So we're going to go into our next video right here. Now, our next video is going to be how some of these titles, this is going to be how consumers are rejecting interest rates. Okay, so this is how consumers are canceling their loans because they're starting to wake up. In other words, that huge spurt of buying demand, it's fizzling like crazy. I didn't expect it to be so strong myself, but it's fizzling like crazy. We're going to see that in this next video. They're going to go on basically the cancellations and how the consumers are starting to say, wait a minute, I didn't sign up for these interest rates. You know what I'm saying? I almost said I'm a single mother. What's wrong with me today? All right. Anyways, I'm going to play this for you guys. Let me know what you think. If you guys can comment, something's wrong with my,
heard a lot about, student loans coming due and that kind of, I like how the Journal put it the other day, it amounts to a 5% pay cut for a lot of workers. But what do you see as the real risks out there?
Well, there's a lot of risks, unfortunately. The good news is the resilience of the U.S. economy and the resilience of labor markets. That's by far the most positive news. On the flip side, we're seeing the headwinds start to pick up in terms of everything from those student loans coming due, which we'll start to see in October, but also a tightening in credit conditions. We've seen people now turn down much more readily for everything from car loans to credit card loans to mortgage refinancing. Not sure who's doing mortgage refinancing out there and why they would be doing it right now, given the rates we have. But that said, we are seeing those turn down rates pick up, and they're at the highest rejection rates on new loan applications that we've seen since 2013 when the data started. That doesn't give us a good sense of whether or not, this is really, really worrisome or just a little worrisome. But I do think it is headwinds in terms of growth going into the second half of this year.
Not to use market terminology, but are you bullish or bearish, Diane, on the economy? Because it's been, more resilient than expected. We saw Hatzius yesterday taking his recession odds down to 20%. What do you think is going on here?
I'm cautiously optimistic that we could get a softer landing than I thought was possible. It's never happened, but never say never in a post-pandemic economy, because a lot has been humbling about this post-pandemic economy. So I'm more optimistic than I was that we can get a soft landing. That said, I do think it's really important to remember that there are some kinds of inflation that we're going to see later this fall that I do think the Fed is going to be worried about could reignite some cooling embers. And that's where I won't completely take November off the table. I hope they'll be done in July, but I think the jury is still out on November on whether the Fed thinks they're going to have to raise rates again, given what could be a bit of a reacceleration late in the year.
Steve,
in inflation.
The retail sales, it's almost like I don't know if it's worth spending any time on, because, we all know about the cardboard box recession. We were just, Josh Brown was just talking about Live Nation. We're all talking about this. So I don't know. How telling is the kind of goose egg we got for core retail sales?
Well, I was at one of those Live Nation concerts over the weekend in San Francisco at Dead & Company. And let me tell you, there were like 50 or 60,000 fans out there who didn't see a recession. They saw a lot of Grateful Dead music is what they saw. And they were buying hot dogs and beers and all kinds of things. It was a little crazy. But here's the thing. I would acknowledge Diane's headwinds, but also point out that, planes land all the time into headwinds. And it doesn't stop them from landing. Sailboats go forward into headwinds. Depends on how you jigger the mast there, so to speak. So what I would point out, and I think Diane would acknowledge this, is another aspect of what's going on is that real earnings are positive at this point. And we had one of the biggest bumps in real weekly earnings that we've had, that's inflation-adjusted earnings we've had in a while. So against those headwinds, which I acknowledge, and they're real, and especially the one about the Social Security payoffs running off, the student loans, all of those are true, but there are offsets to those headwinds. There's an engine out there, and it has proven to be resilient. And I've been in the no recession camp for a while, just as well as I monitor, Kelly, as you know, all the time, the economist forecast. And all they can do at this point is to push ahead their forecast for when that recession begins. And how strong growth is in the second quarter is both objective and subjective. And it's objectively weak relative to, say, trend, but it's subjectively strong relative to the recession that had been planned. So I'm seeing a forecast of 1.5% to 2.5%. But guess what? It's on the right side of the zero line. It has a whole number in front of it, and that's way better than many expected for this quarter.
Diane, you're also keeping an eye on the strikes. Why is that?
Well, the strikes there's a huge number of strikes. One, there's UPS strikes, a UAW potential strike. Those are just potential strikes. And then the SAG strike. And the SAG strike, although it doesn't affect as many as the 160,000 people who are covered by the SAG contracts, it does include a lot of spillover effects in Hollywood, which is over 457,000 people that work in the movie and production industry directly. And then there's the indirect spillovers as well. And we won't see the effects of that unless this lasts for a really long time. And we won't begin to see it until after that first full week in August, which is the week of the survey week for the employment data, which is right before the Fed meets in September. And I think it's very hard for the Fed, given the kind of noise we're going to see, some of those things to be in the middle of thinking about raising rates any further. I also think the Fed wants to get more news on the cooling inflation. And I think July is going to come in another good number on inflation. I worry about the end of the year. We're starting to see some reversal. We'll start to see some reversal in the medical care costs. That was a major driver of inflation in the 1990s and for many decades, as a matter of fact. And that picking up again could be something that the Fed, especially in the service sector outside of shelter, that would be something the Fed would be very concerned about.
All righty, so
My
I'm
business
turn
runs
this
on
commercial off real quick, you guys. My streamer completely froze. FG, I did not hide your comments. Facebook hit your comments, and I'm reading your comments. I haven't hit any comments, but Facebook is automatically doing on some of them. They're funny. You guys are so funny. Okay, so let's see. Let's look at the 5-year break even. Very, very important chart. Remember, we've been watching this 5-year break even. This is something that's really important to the Federal Reserve. Let me max this out. This is basically the market anticipation of where inflation is going to be 5 years from now. The expectations of inflation. And you guys may be thinking, well, why would the Fed care about the market's expectations? But it is what it is. It's wild to me as well. But look at where, again, historically, this is where we need to be. We basically need to be under the 2% line. You guys can't really see that too much, but basically from about 2009 all the way to 2019. So the last decade, the market's 5 years expectations has been well under 2%. So this is what the Fed wants us to be. They want us to be under 2% or right at 2%. Now you can see obviously the expectations of the market ballooned up here, but let's see what the current trends are. Now, the interesting thing is it did go down yesterday to 2.13. Now, here's what's interesting. This may finally break a trend, because the expectations has been going up since June, probably ADP job report, right? Or something of that lines. But the expectations, which is not good for the Fed, has been going up. You know, you guys can see it's been going up and down, but the trajectory, if you look at the bottoms, has been going up. Now, so right now we're at 2.13. If this goes down to 2.11, it will have broken the upward trajectory. Okay, because remember the last bottom is right here at 2.12. So it's very close to reversing the trajectory, which is something that the Federal Reserve wants to see, and that will signal to them that they don't have to be as aggressive. So if you want the Federal Reserve to be aggressive, you want to see this go up, not down. Just put that in perspective, okay? Now, real quick, we're going to go into the next video, which is the bank earnings. Man, a lot of people thought the banks were going to be doing bad when the earnings came out. I can't believe my StreamYard is frozen. But the banking numbers actually turned out to be fairly good. And why do you guys think that is? Why, like Bank of America, for example, Morgan Stanley, a couple of these companies did not do good, but some of these banks showed pretty good profit. Now, do you guys think that's a result of the discount window? Maybe you do, maybe you don't. We're going to look at that here. The video is starting. We're going to look at the total assets. We'll look at the M2 here in a minute, but let's kind of listen to our last video right now, you guys, on the banking situation. Very important to follow. I cannot believe I can't see your guys' comments except for on my cell phone. So sorry, guys.
How would you characterize the quarter for the banks?
Hey, Sarah, how are you doing? Thanks for having me. So, the bank earnings season has gotten off to a better than expected start with the biggest banks reporting. Some of the panicky fears to which you alluded a couple moments ago, they seem to have dissipated. I think investors are reflecting that in valuations. So, realistically, this strong start we've had from the biggest banks, that could lose some momentum as more regionals and smaller banks start to report. They might see more pronounced pressure on their deposit costs, but overall, a pretty good start to the season.
I mean, David was mentioning PNC and some of the regionals. Even the regionals appear to be in better shape than what was expected. So is there an opportunity here for these stocks?
To a degree, we've got historically low valuation. So I think today what you're seeing is probably some of the regionals, even, you alluded to PNC, that had a a little bit of a weaker than expected guidance, for instance. But I think it's still being pulled up by some of the stronger results you saw at maybe like a Bank of America, for example. And even there, they guided to perhaps a better than expected net interest income outlook for the remainder of the year. So I think that's sort of buoying some investors' hopes here for what the outlook will be like in coming periods. But you even mentioned it a couple moments ago. There's still plenty of wild cards out here. So from my standpoint, the question of sustainability of the recovery in bank shares, that's still a little bit of an open question in my mind.
You've got to sell on Bank of America, right?
Ooh.
Yeah, so we've got an underweight on it. I mean, it's a great company. It's done well over time. I think we tend to look at it in the vein of its peers, probably its closest one, JP Morgan, for instance. And, we just see better reward in JP Morgan, which is our favorite universal bank name. If you listen to Jamie Dimon's comments, JP Morgan really just blew NII out of the water a couple of days ago, which was great. But he's quite candid about the likelihood that their net interest income will likely fall, and is really overstated at this point. So whereas Bank of America is talking about maybe a little more stability, that's great, and it's certainly helping the stock today. But in our view, even if that's the case, for B of A, that probably means even better things for JP Morgan, just because the expectations are a little more rational there and would have more room to move up.
You alluded to the fact that you seem to be looking for more signs to get more positive. What would they be?
Yeah, do you mean on B of A or just generally? I think
generally, more generally.
Yeah, where I'll address that. So a couple of things. We've got both supply and demand issues in terms of loan growth, right? It's really at this point only credit card, which is just sort of a scale business. You've got JP Morgan, B of A, to a degree, Citigroup. But most regional banks don't have that tailwind. So there's really a diminishing share of the pie that's driving most of the growth there. Additionally, we've got a lot of open-ended questions on where capital and liquidity requirements are going to go. So we need to resolve some of those. And then there's, of course, sort of the ... of eventually we'll have a credit cycle. David, you mentioned commercial real estate, and I'm afraid you were exactly right in your conclusion. We could be talking about that for up to a couple of years. Unfortunately, it's just not going to have sort of an aha moment where we can sound the all clear that everything's okay. So just a lot of unanswered questions here that we'd like to get some better clarity on.
All right, guys. I know it's
because you
CNBC,
used
I know
Workday
it's
to
CNBC, but
transform
we got to
your
listen. I mean, we got to take into consideration some of these things that people are saying. We don't just want to hear what we want to hear. Okay, we got to be aware. It's painful. But let me show you guys a couple things, and we're going to end this out. So, as far as the quantitative easing, let's not forget again. The economy is doing so well, and probably banks are doing so well because of this massive you see this huge $400 billion right here? It's probably because of that. But I did want to say we are under now. So the quantitative tightening is working. They did purge all of that off of their balance sheet, but it's somewhere else in the economy now. Okay. And let me show you where we can see that. So again, this money here, this 400 billion roughly of dollars, I think we're starting to see that hit M2. Look at this. So this is the M2 money supply right here. This is basically how much money we have in the economy. They were doing great, actually. The quantitative tightening was it was doing great. You guys can see from about January to about May, we actually lost about, I think it was 4%, close to 4% of our money supply in a relatively short amount of time. That was tremendous. But look at this, guys. It has now since about May. And I waited to talk about this because it kind of plateaued right here. But now, I mean, it's time to talk about it. I mean, I think we're seeing the quantitative easing in March hit the economy. I think so. I think that's why we see that right here. And that's the adverse reaction of the quantitative easing. That's what I keep saying. Oh my God, quantitative easing, why'd they do that? It changed my soul. But the reality is, and this is what Danielle has been saying, the economist we just listened to, she's basically saying Jerome Powell did the right thing by bailing out the banks so that they can keep us on this plane ride of quantitative tightening. If Jerome did not bail out the banks, all hell would have broke loose. Chaos would have spiraled out of control. They would have had to stop doing quantitative tightening. How long would it be before we've be in the same situation we're in now? That's the point I'm trying to make. So I want to believe that he's strong, you guys. I want to believe that's what he's doing. I'm not 100% convinced of that yet, but I'm definitely leaving room in my heart for the hope that Jerome Powell is doing the right thing. And the reality is Jerome Powell is strong and Jerome Powell is tricking the market. He's certainly lying to us as consumers. I hope he's also lying to the market, because if he is lying to the market, I will take back what I'm saying about him, and I'll say, you know what, Jerome? I'm glad you bailed out the banks, because by doing so, you allowed us to be in quantitative tightening for another year. And as a result of that quantitative tightening that we're in for another year, you were able to make permanent policy changes. So we're not in this situation. But that's the thing, you guys. Stay in quantitative tightening. Keep doing your work, Jerome. But do something about the problem. Maybe institutional investors is a huge issue, right? All of these tax incentives, maybe come up with some affordable housing options, convert, buildings to apartments, do something. Anyways, guys, that's it. That's this morning's episode. I am sorry I didn't pin your comment, Omaha. I could see it on my cell phone. He said the word crash, you guys. I just can't pin it. I'm really sorry about that. Something's wrong with my StreamYard. I don't want to learn OBS. I guess I can learn OBS. But anyways, guys, have an absolutely great Wednesday. Thank you for joining me today. Tonight's video will be of the eviction crisis. And I'm really going to dig in to show you like some of the absolute worst zip codes. And I think you guys are going to be absolutely shocked. But other than that, you guys, I hope you are conquering your goals. I hope that you know that you're loved. I hope you know that you're appreciated. And I hope you know that there is no need to rush the biggest financial transaction of our life. Purchase smart, right? Not emotionally. All right, guys, if you're out there investing in real estate, you know I wish you luck, and I hope you win.